Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stennebeck on Bloomberg Radio.
All right, Fed Decision Day, the 8th and final FOMC meeting of 2025. It is done, and widely, as expected, the Fed cutting rates for a third consecutive time.
The Fed also maintaining its outlook for just one cut in 2026. Okay, so
Right.
2 dissents last time.
Yep,
This time 3 dissents.
correct.
But in different ways.
Correct, kind of spanning everything. It
Right, we
almost feels
expected
like.
Stephen Myron to want a more aggressive interest rate cut.
Right.
At 50 basis points. But maybe what people didn't expect were 2 dissenters who wanted to hold rates steady.
Mr. Goolsbee of the Chicago Fed and
Mr. Schmidt of Kansas City.
yeah, exactly, saying we didn't need to do anything.
Okay.
Yeah.
So not a lot of consensus, but
Must have been a healthy debate around the Fed table.
be a fly on the wall.
Yeah, exactly. So now we're done for the year, and now we think about what's going to happen next year. We got a lot of commentary on that from Fed Chair Jay Powell. In fact, one of the things he really emphasized repeatedly in his comments, in his opening statement, that the committee is in a wait-and-see mode, also noting by our count, thank you, Talia, our producer, for actually pulling this out to our attention, noting by our count for the third FOMC meeting in a row, saying there is no risk-free path forward. It's a challenging situation.
In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy. We're going to get a great deal of data between now and the January meeting. Everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is? And you know, it's very unusual to have persistent tension between the two parts of the mandate. We're well positioned to wait to see how the economy evolves. We'll just have to see. It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
All right. Very challenging situation. Fed Chair Jay Powell at the press conference. He also did say gradual labor market cooling justified that rate cut today. So talking about some weakness that we've got in the labor market. Next FOMC decision, folks, not that we like to kind of look ahead, but we do. January 28th, 2026.
Mark your calendars.
I am. Are you?
Oh, yeah.
It'll be the first of 2026. Jay Powell still will be Fed chair, so it'll be interesting. We should point out after the decision, President Trump at the White House made some comments, Tim, on today's Fed move. He said that could have been doubled, at least doubled. Not a surprise. We have heard criticism from the president when it comes to Fed chair Jay Powell.
Well, interestingly enough, that's where Stephen Myron, Stephen Myron voted, who's widely seen as somebody who has the most connection to the White House, who's on the FOMC.
Yeah, exactly. Right. All right. So let's do a little bit more in terms of the commentary around this decision. We've had a lot certainly come across the Bloomberg, including our live blog. Let's see what our Bloomberg Intelligence chief U.S. interest rate strategist, Ira Jersey, has to say about this. All right, Ira, we have heard from Fed Chair Jay Powell for at least the last 3 meetings where they cut that both sides of the Fed's mandate is challenged and at risk. The Fed decision today, does it make sense to you?
I think it does. I mean, it was fully priced, and you know, clearly when they pivoted to worrying more about employment than inflation, they were going to go more than 50 basis points as kind of these risk management cuts. And you know, now that they've cut 75 basis points, another key phrase that Jay Powell said was that that they're now in the range of neutral. So basically, with all the committee members, what is this mystical R-star or real neutral rate, and are we there yet? And he conceded that he thinks that they're are now in the range of being at neutral. So therefore, this could be the end of cuts, or maybe they're going to cut again unless the economic data changes enough for them to be comfortable cutting again. Because like you mentioned, he did say that there's still this balance of risk between inflation and employment.
Yeah, exactly. And look, he did say we're even between now and January, not to mention between now and the end of next year, when some people think that another 25 basis point rate will happen. He said we're going to get a great deal of data between now and the January meeting. So a lot can change, or a lot can be confirmed in the meantime, Ira. Before that happens, though, I want to go back to this tension between the different parts of the dual mandate. Which part do you believe the Fed needs to focus on more? Is it inflation, or is it maximum employment?
Well, I actually think that at the moment there's very little that they can do about inflation, because the interest rates still are relatively high compared for like the housing market, and there's not much that the Federal Reserve can actually do to help the housing market right now in terms of bringing house prices down. Like, what are they going to do? They're if they lower interest rates a lot more, that's just going to increase the value of some people's houses, because maybe mortgage rates come down a little bit. That increases affordability, and suddenly house prices actually go up, which is actually against their mandate. And for other goods and services, they don't seem to be particularly elastic. Like the elasticity to interest rates and a lot of these other goods, whether it's even automobiles or any other large purchases, there just doesn't seem to be a significant correlation between the two at the moment. I think part of that is, quite frankly, because a large portion of the population does have very low interest rate mortgages, so they're not going to refi. Lowering interest rates isn't going to be as stimulative as it has been in previous cycles. And at the same time, lowering interest rates again isn't going to necessarily bring inflation, make inflation go significantly higher if you don't get a big lending boom. And I'm not sure that lending has increased a whole heck of a lot anyway. Anyway, the fact that they're close to neutral, and we've always thought that they'd probably cut a little bit beyond 3%, because personally I'm a little bit more concerned about the job market. I think the job market shows some cracks beneath the surface that some people are either ignoring, or everyone's making an excuse for why we're at 50K-ish payrolls the last couple of reports that we've gotten. But the fact is that companies are still reluctant to hire. You have seen in some of the survey data maybe that leveling out a little bit.
Yeah.
But I'm still concerned about the job market, and I think that the Fed is, and the people who voted for the cut certainly are worried about the job market more than inflation.
And we get a read on that next week. Hey, one thing I want to do before we go, we've got about a minute and a half or so left here. Just quickly, Ira, the Fed moved to expand its balance sheet again, fresh purchases of short-term Treasury securities to maintain what they said, an ample supply of bank reserves. Just got about 30 seconds. What do we need to know here?
Yeah, well, that's actually probably the bigger story even than everything else that we just talked about, because it's much larger than most of us thought it would be. They're adding somewhere around $160 billion of T-bills over the next couple of months through the April tax day. Risk assets seem to like that quite a lot, and it made the whole meeting a lot more dovish, according to, I think, a lot of people's sensibilities, and just looking at the whole cut plus the QE light, if you want to call it that.
All right, good stuff. Ira, thank you so much. We'll be looking out for your research also later on today and into tomorrow. Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence from BI headquarters in New Jersey.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
We're staying on the Fed decision today. We're also thinking about Fed leadership come 2026. We've got a great roundtable. Steve Moore is with us. He's co-founder and chair of the nonprofit Unleash Prosperity. He's a former economic and senior policy advisor to Donald Trump in 2016 and 2024, and served as chief economist and distinguished visiting fellow at the Heritage Foundation for 12 years.
Yeah, he's also written a bunch of books, including Trumponomics, Inside the America First Plan to Revive Our Economy. Also another one, The Trump Economic Miracle. And you might remember back in 2019, President Trump selected Steve Moore for the Federal Reserve Board of Governors, which Moore ultimately withdrew from. So we have a lot to unpack and talk about. Steve joins us from Palm Beach, Florida. Great to have him here. Also with us is Bloomberg Economics U.S. and Canada economist Stuart Paul. He's right here in our Bloomberg Interactive Broker studio. Steve, I want to kick it off with you. Welcome. Nice to have you here on Bloomberg. Your key takeaways from today's Fed decision.
Well, it was certainly Wall Street was happy with what happened today. It was very expected that the Fed did exactly what they announced today. Trump, of course, wants more rate cuts. Look, inflation has come down, and it's still not where we want it to be. We want it to be at the 2% Fed target, and so we're running about 2.7, 2.8. So there's still work to be done to bring inflation down. Of course, if you bring inflation down, affordability goes up. But look, this is a booming economy right now. It is so hot. Trump is right about that. And 2026 is going to be a monster year for growth and for incomes and I believe for equities.
If you were on the FOMC and a voting member, how would you have voted today? What would you have wanted to see?
I would have done exactly what they did.
You wouldn't have gone 50 basis points like Stephen Myron.
No, I'm a little bit more of an inflation hawk than Stephen. I know Stephen, he's a smart economist. I lean towards making sure, I think the top priority of the Fed should be to make sure that we bring that inflation rate down to the target level. We're not there yet. And, look at as a political matter, Trump really needs to continue to bring that inflation rate down because people are still angry about prices.
Mr. Moore, it's really difficult to square the circle between being an inflation hawk and voting for or advocating for additional rate cuts when you see somebody like President Trump focusing so much on affordability, but at the same time calling for the Fed to cut rates even more. How do you really square the circle? How would you rationalize voting for a cut while also being an inflation hawk?
Well, I believe that Wall Street puts way, way, way too much influence and interest in Fed rate cuts. I mean, the short-term interest rate has become almost irrelevant. So I really don't believe that it's all that important, frankly, whether it was a quarter point or 50%, 50 points or doing nothing. I don't think that it makes all that much difference. We should have learned the lesson, by the way. What we'd all like to see is for those mortgage rates to come down and the 10-year Treasury interest rate to come down. Well, the Fed doesn't control that. I know that may surprise people watching this. The Fed has no, impact on the 10-year Treasury or the 30-year mortgage. And we know that, by the way, for what happened in 2024 when the Fed cut the discount rate and what happened to the Fed funds rate and what happened to the mortgage rate and the 10-year Treasury. It went up. So I don't overly obsess about Fed rate cuts. I think we're in a pretty good look. The most important thing is this incredibly healthy economy. We've got hundreds of billions of dollars coming into the U.S. economy of foreign investment. We've got the highest S&P 500, the highest Dow, and the highest NASDAQ in the history of the country. People are making huge amounts of money, and this is a bet. When the markets go up, this is a bet that policy will be well guided and that American companies are going to make money. So I have a hard time really having much problem with the direction that we're going in with respect to this economy. And don't forget, starting in January, people will start to see middle income people will start to feel the impact of those big, beautiful tax cuts that passed in terms of less money deducted from their paychecks and taxes, and the no tax on tips, the no tax on overtime. Those are all positive features that will help middle class Americans.
That's a really interesting point that fiscal policy is going to be especially accommodative in 2026. And I think that one thing that's interesting is whether we're going to see monetary policy that's equally accommodative or even more so. And that's going to really depend on who we get as the next chairman of the Federal Reserve and chairman of the FOMC. What do you make of the White House's floating of a trial balloon with Kevin Hassett about 3 weeks ago, and then seeming to reconsider? If there's anybody in the world who recognizes how difficult of a process it can be to make it through the Senate, it's you. And so I'm really interested to hear what your thoughts are about what's going on in the White House and on Capitol Hill in terms of whipping up the votes to support someone perhaps like Hassett or Warsh.
I like them both. I think the two Kevins, I've been saying this for 2 years now, that, it should be one of those two as the Fed chairman. I also like Larry Kudlow, but I don't think Larry probably is in the runnings to do it, but he'd be an excellent Fed chair as well. But look, the two Kevins are monetary experts. They're extraordinary economists. I really, truly, either one of them, I think, would be fantastic picks. And I think they would also keep their eye on the most important thing that the Fed needs to do, which is defend the dollar. Defend the dollar, make sure that it's strong and stable. That's all the Fed needs to do. It doesn't have to worry about jobs. It doesn't have to worry about climate change or any of these other things. The most important thing is to keep prices stable and the dollar strong. And I think both would do that.
Steve, you have some great insight into President Trump behind closed doors. You know, he did nominate you for a Fed governor position. You ultimately backed out of it. But I'm just curious, what were your conversations with President Trump, or what insight can you give to our audience and investing audience trying to understand, read the tea leaves? Because we do have a president that most would agree that he's transactional. And so I think we're trying to understand that in terms of any appointments, is that seen as an expectation that you're going to do the President Trump's bidding and listen to him if you are at the Fed in terms of what needs to be done in cutting rates, if that's what he wants?
Well, look, my opinion is that it is valuable to have an independent Fed, but I also believe the Fed needs to be accountable. And in my opinion, it hasn't been accountable in the last few years. That's why we got, a 9% inflation under the current Jerome Powell. And so
wouldn't you say that 9% was the result of the pandemic and incredible demand? I mean, there were some, unexpected events
and
that created
fiscal policy too.
Fiscal policy. There was a lot of money sloshing around. Wouldn't you concede that 9% inflation, any president or any Fed chair would have had to deal with that?
Well, listen, I mean, I do think that Trump made a big mistake in that he passed a big, massive spending bill right before he left office. So you make a good point, but it was catastrophic. Everything that happened under COVID. We made the biggest mistake in the history of the United States in shutting down our economy, shutting down our schools, shutting down our hospital. It was outrageous. And I think we've hopefully learned that lesson that we'll never do it again. But you are quite correct that what caused the inflation, and I hope we remember this lesson for many, many decades to come, is that when you massively spend $4 trillion, guess what? You're going to have inflation. And it didn't stimulate the economy. It caused huge reductions in real incomes for middle-class people. It destroyed middle-class incomes. They lost massive amounts of money because we very stupidly printed all this money and spent it, dropped it out of helicopters. And that's a policy that's never worked.
So I want to go. Look, I think it's you bring up a lot of important points about what happened during the pandemic and the causes of inflation. But to Carol's point, you do have this direct line to the White House and to the president. You advised him back in 2016. You advised him in 2024. How would you characterize your relationship with him right now? And to what extent are you, and how often are you speaking to him about economic matters that hit the United States?
By the way, I hope there isn't still a debate about what we did of COVID, because it really is important that we learn how incredibly inept almost everything that we did. And by the way, I'm in Florida right now in Palm Beach, and one of the few politicians who got it right was Ron DeSantis, the governor here, who did not shut down the Florida economy. And you had these blue states like New York and California and my home state of Illinois that shut down their economy. And that's one of the reasons the way these blue states have never really made a recovery from their tragic mistakes.
So and look, I don't think we don't have a ton of time, so I don't want to rehash the past. And I think we could do an entire segment with you about that. And that's not something. It's not something that we're
lesson for people to learn, because it was we don't want to ever make that mistake again, right? We don't.
And hopefully we don't face another pandemic. And I don't think any of us were countering what you're saying there. What I'm interested in is what you're talking to the president about right now. What is the line that you have to President Trump on economic policy?
What I tell him is that I think the tax cuts have been enormously beneficial, and it's not accommodative fiscal policy on the tax side. What it is, I mean, like one of the most important things we did in the Big Beautiful Bill was we are allowing businesses to instantly capitalize their expenditures and write them off instantly. And I believe that's one of the reasons we're seeing this capital boom in the United States. I mean, if you look at the last 9 months, capital investment has been really strong as a result of this tax cut. So it wasn't really meant to just pump money into the economy. It was meant to incentivize through lower tax rates, lowering the corporate rate, giving expensing, lowering the individual income tax rate. Those are pro-growth, pro-supply side policies that actually help bring inflation down. I mean, it's very simple. If the economy produces more, prices go down.
Hey, one of the things I do want to go back to this idea of transactional. And again, I want to go back to the insight that you have in having conversations with President Trump before he, made a nomination for you to join the Fed and be a governor. Because we've heard the president come out and say Jay Powell has been very bad for our country. He's terrible. He's a terrible Fed chair. I'd love for him to lower interest rates. I call him too late. I'd love to fire him. Tell us about, would there be pressure by President Trump with who he appoints for the next Fed chair? And would there be an assumption by the person who takes that position to kind of do the president's bidding? Give us some insight if you could.
Well, I'll put it a little differently. It's a good question. First of all, when I was nominated to be on the Fed, Trump never really, asked me about, well, would you cut rates or would you raise rates or so on. He had trusted in me as an economist that I would get it right. So there was no pressure to sort of do his bidding. Now, with respect to Kevin Hassett or Kevin Warsh, which I think there's a good chance it's going to be one of those two, what he is doing is picking someone. You say do his bidding. He's picking someone who agrees with his overall economic philosophy. And that's exactly what a president should do. I don't think that means undue influence on the independence of the Fed. But I think it's basically, presidents deserve the monetary policy they want, frankly, and so, I think they will do. They agree with Trump on monetary policy, and that's one of the reasons one of the two of them will be chosen. But I can't think of two economists I admire more than Kevin Hassett and Kevin Warsh.
It's interesting that you bring up President Trump's economic philosophy, because I think that if you were to press him to describe his economic philosophy with regards to monetary policy, he would just say he's a low interest rate guy. So is the expectation going to be from Kevin Hassett or Kevin Warsh that they will just deliver low interest rates?
You make a good point. The one thing that Trump has often said to me is that he likes low interest rates. And I've always said, well, Mr. President, low interest rates are good, but we also want to make sure we don't cause inflation. And so that is the kind of dual competing interests here. But I think he gets it that, what destroys a presidency is inflation. For whatever reason, we saw Jimmy Carter lose because of inflation. We saw Jerry Ford lose because of inflation. We saw this. I think the major factor in this last presidential election was inflation. Americans hate higher prices. It's one of the reasons they're still in a foul mood on the economy. So I believe that Kevin Hassett and Kevin Warsh, either one of them will be an inflation hawk, and I predict we will bring that inflation rate down to 2%.
But one does wonder, since he's not running again, assuming no third term, that maybe he doesn't care if there's inflation. I'm just going to put that out there. Okay. I know you want to go somewhere else.
I mean, the Republicans certainly care, and affordability is going to be a key message for them for everybody in the midterm.
We shall see.
Hey, we only have 30 seconds left, Steve. I just want to take a sharp turn here. Because you are an economist and you watch what's happening closely, the U.S. taking a stake in publicly traded companies such as Intel, MP Materials, and others.
I don't like it.
Why not?
Hate it.
Why?
No, never. I've spent most of my career trying to privatize, not nationalize. So it's one of those issues I disagree with the president on. I believe in separation of business and state, and the less the government does to influence business decisions, I think the better.
You're old school that way.
There I am.
It's a different.
I hope it's not old
definitely
school.
a different Republican Party, at least from a business perspective today.
I think there's a lot of investors out there too who certainly would agree with you. Steve, thank you so much. Really enjoyed this. Steve Moore, co-founder and chair of the nonprofit Unleash Prosperity, and of course, as we said, a former economic and senior advisor to President Trump in both of his terms, and of course, Our great thanks to our own Bloomberg Economics U.S. and Canada economist Stuart Hall.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Oracle shares, they are down about 5.5% here in the aftermarket. Meantime, Adobe shares, they're right now little change, but they've been bouncing around a little bit.
I want to bring in Bloomberg Intelligence Senior Technology Analyst Anurag Rana to break down these earnings. I want to start with what's going on with Oracle, down close to 5% in the after hours. The company reported adjusted revenue for the second quarter that met the average analyst estimate. Adjusted revenue coming in at $16.06 billion. Cloud revenue coming in at $8 billion. What's your initial reaction here, and why are we seeing the stock lower?
So when you look at Oracle results, as expected, the backlog or the bookings numbers was very strong. That's over 500 billion right now. But the realization of some of that into revenue, onto cloud revenue, it was slightly lower than what Street was expecting. And one reason for that could be supply constraint. They may not have the necessary chips or equipment to fulfill that demand. So I think there is going to be a lot more discussion on the call about it. On the other side, there was a little bit higher capex as well. So for Oracle right now, I think the backlog or the order book does not matter. What really matters is how can they convert that backlog into sales over the next few years.
All right, so you're talking about the RPO growth, right? And we are getting another headline that says it's aided by commitments from Meta and NVIDIA. I mean, in terms of where this commitments or these, order flow continues to come from, does it matter that it still is so concentrated in the hyperscalers?
Well, as far as the concentration is concerned, really depends on who's committing those promises. If the promises are for somebody like a Microsoft or an Amazon or somebody else like Meta, it does make sense because they actually have the cash flow to support it. But the big question for everybody is, if these out of that 300 plus billion commitments are from OpenAI, where does OpenAI have the money to fund a lot of this expansion? Now, OpenAI thinks over the next few years they can get to that point where they can then spend that money. But in terms of certainty for an investor, I think you're better off when the commitment is coming from a Meta or a Microsoft.
Hey, Anurag, can we assume that those folks that continue to invest in OpenAI, they have looked at the books, they understand the financials of OpenAI, because it is not a publicly held company. And we know there are some big time investors, including Microsoft, in that company and others. But can we assume that there's a real business there, even though there's a lot that we don't know about it?
Oh, yes, absolutely. There's a real business. 900 million users. And for ChatGPT, this is the biggest consumer app out there when it comes to AI tools. So there's definitely a real business there. But the big question is, do they need to spend, 300, 500, 700 billion down the road in order to train their models? That's an area where we are not sure how that translates into future revenue.
I'm looking for the word debt in the press release coming from Oracle. I don't see it anywhere, Carol. But not too surprising, I think, that
I'm sure it'll come up on the call.
It'll definitely come up on the call. But how should investors be thinking about Oracle's debt position? Because that was a concern a few weeks ago, and we saw CDS valuation as a result.
Yeah, see, when you look at the size of their order book, they just cannot fund it themselves. It's just not possible given the free cash flow that they generate. So they have to do something called a special purpose vehicle, where you'll have a private equity player, you will have private debt, and then you will have investments from maybe SoftBank or on the others to create an entity that can fund a lot of the Stargate orders that are flowing in. So it is going to be a little more complicated than straight out going to the debt market and raising capital.
I know, because at some point I always wonder, when there's a lot of debt being created and there's a lot of investors involved, how much are willing to throw more money at it to make sure that it all plays out, right? Because the nervousness of it not happening, maybe because just of a shortage of capital.
Yeah, but Carol, if you look at it, when they last came out in the market, the news that we heard was it was oversubscribed. These companies are not having at this point any trouble raising capital for data center expansion.
All right, let's go to Adobe.
Yeah, I'm just looking at what's going on with Adobe right now. The company gave a strong sales growth outlook. It eased concerns about AI. The company giving an outlook for revenue in the coming year that topped analyst estimates. It suggested that AI features are helping fuel growth of its creative software business. Just looking at shares of Adobe in the after hours, they are kind of unchanged. They bounce around a little bit, but right now down about 0.3%. What do we need to know about Adobe's report?
Adobe's management needs to just come out and say we are executing properly. They are, I always say, not worried about AI cannibalizing their business. Their margins were very strong this time. What they promised a year ago, they actually fulfilled it. For the next quarter, they are talking about 10% growth in the overall company annual recurring revenue. So I think overall good results, but this is a company where honestly, the sentiment is so negative. No matter what they do, they just can't get a break.
Hey, listen, the story today too, Anurag, is that ChatGPT users can now use Photoshop and other creativity software from Adobe directly within the chatbot. So we're looking at OpenAI continuing to bring kind of third-party apps into its product. Sounds like a plus for Adobe, is it? And where is Adobe's role in the AI world? Where does it exactly fit in? Is it like an add-on or what?
Yeah, so when you look at, I think the biggest threat, the reason why Adobe stock has not been able to recover over the past 2 years is the biggest threat is a lot of their main products, their cash cows, whether it's Photoshop or some of the other video editing tools. People are saying, I can go to an open source model and create a lot of that myself. Now, we don't think there is a reason to have Adobe down the road because of workflow issues and how you edit those things and how you manage that. But that is the threat. And I think the only thing that can help them is if they consistently execute like this for next several years and showcase that their own AI products are gaining momentum and they're working closely with people like OpenAI and people like Google. I think they're both integrating those models into their workflow also.
Yeah, that's hard though, because in Adobe, what they want to do is they always want to come out and say, our images and what we create are commercially safe. So what essentially that means, the translation is that if you're a creative and you're working on an ad campaign for a company, you're going to know that whatever Firefly or whatever Adobe product you're using, whatever it spits out, is something that you're not going to get sued over. And that's not necessarily the case with the other Gen AI models.
No, I agree. But if you think about it, there is a case that if there is a pyramid of customers, on the top you have the enterprise customers who are very concerned about it. But it's possible at the base layer, there may be customers, either they're individual users or, very small companies.
Yeah, that's a good point.
They don't really care about
some
it.
sort of person posting on Instagram isn't really going to care if what they create is can violate copyright. Okay, I get it. That makes sense.
All right.
Where do you want to go, Carol?
Well, I'm just thinking, you guys have a massive AI report that is out there, so timely as we get ready for a new year. And it gets into cross-industry disruption of AI.
And this is what Fed Chair Jay Powell was asked about today.
Yes, exactly. He talked about it. And, so I'm just curious, talk to us about this report, who you guys all talked to, and what were some of the key findings?
Yeah, we embarked on this several months ago, and our entire take was we have all this CapEx spending on the tech side. What are the users saying, whether they are financial services firms, consumer firms, hospitals, pharmaceutical companies? So we went out and looked at 9 industries and over 600 C-suite executives that were surveyed for this report. And I think the biggest thing, the grand takeaway for us is every sector is extremely worried about being disrupted. Now, for us, we thought only the software companies would be worried about it. But, we saw industrial firms, auto firms, hospitals. They were all saying that, okay, this could shake up our business. So we need to invest and invest more. The second thing we saw was even in these sectors that you could consider laggards of technology adoption, the people who are, part of the employee base, they're very, very apt at using these AI tools that we talk about, whether that's ChatGPT and the others. So the level of awareness is there, the understanding is there. Now it's going to take some time for them to flow a lot of those technologies into their core business so that they don't get eaten away.
Hey, one more on this, and it has to do, again, we're just coming off of a press conference with Fed Chair Jay Powell, where I personally thought, and I told you this, as the discussion was going on, one of my biggest takeaways was his answer about AI and productivity.
Yeah.
And the idea that productivity growth in the U.S., he didn't think that he would see a period of time with such an extended plus 2% in terms of GDP growth. And, we don't know what we can attribute to AI, but there are also so many questions about, okay, what is going to be the effect on employees? What's going to be the effect on different sectors of workers? Did you guys hit on that at all in this report?
Yeah, absolutely. And, productivity was the number one factor everybody is going towards. other thing that we have seen, and this is more predominant in the software companies that we cover, is the level of revenue growth and the level of headcount growth has widened. I mean, what I'm saying is the relationship that was very tight before has moved on. So when you have a company growing revenue at a particular rate, headcount is not growing at that rate. We're not saying there are cuts out there, but that delta is where the productivity is coming in, which will eventually lead to, and we have already seen that in certain cases, is higher revenue per employee. And that, I think, is the benchmark everybody needs to focus on.
Right. But he still had to say not showing up in layoffs yet. So, I mean, TBD, right, to see how this kind of ultimately plays out. Hey, before you go, there's one other question we wanted to ask you. Meta Platforms, an open source money or tilting from an open source to a closed source AI model. What is this all about? I think it's called Avocado. It's a new model expected to debut. I know. I was like, what is that? I was trying to understand. Totally California.
So I'll take you back to many years ago when there was Linux and Windows.
Yes.
Linux is open source. Windows, you got to pay for it. You make money when you have Windows. And very few companies out there have made money when they have an open source product. Meta started with this open source model, really, because the thing is, you and I can go and perfect this model, and then we can use it without paying Meta any money. But if you have a closed-end model, you have to pay Meta that royalty. And at the end of the day, they're spending all these billions of dollars. How are they going to monetize it? And I think that's kind of one of the reasons for that pivot.
It's like they were listening to everybody saying, well, how are we going to monetize this? All this spend, how are we going to monetize it? Anurag, thank you so much, man. And that report, I'm sure we're going to lean on that a lot, especially in the new year. Anurag Rana, he's Senior Technology Analyst at Bloomberg Intelligence out there at the Bloomberg News Bureau in Chicago.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Fed cutting rates with 3 dissents, projecting 1 cut in 2026. So we also want to get into kind of how it may impact bank lending as well. We did see banks as a whole, the KBW Bank Index, rally in today's session off of the Fed. With a little bit more perspective, let's get to Zach Wasserman. He's Chief Financial Officer at the Columbus, Ohio-based Huntington Bankshares. Back with us. Company has a market cap of nearly $27 billion. Shares are up 5% year to date. And just today, Tim, Piper Sandler raising the price target on the stock from 15 to 16, maintaining, though, its underweight rating.
Zach, joining us here in the Bloomberg Interactive Brokers studio. Zach, great to talk with you again. Especially appreciate you coming into the studio. Did the Fed get it right today?
I think they did. The analysis they did that showed the labor market still, of course, softening to some degree, but inflation pressures continuing to be present, and with a potential for some higher price pressures as we go into the early part of next year. I think they got it right, and I think the outlook for, they've signaled probably 1 additional cut into 2026. The market, by the way, is baking in 2 cuts for 2026. Somewhere in that range seems very likely, and I think helpful for the economy at this point.
All right, Zach. So if you were sitting down with Jay Powell, what would you want to ask him right now?
That's a good question. What is he going to do after he leaves his job?
Do you think he will leave his job in the spring?
I would think so. That's my sense.
But do you think that also Kevin Hassett is a given? Like, we're seeing that the president's meeting with Kevin Warsh. So it feels like things are still fluid.
Well, I'm not a party to those discussions. I have no clue, but I certainly think that as they think about how they're going to chart their course on interest rate policy, I think the path that they've chosen at this point appears to be the right one. Very data reliant. Appears to be, we're landing the economy in a sweet spot.
Okay, so can Carol, are you done with Fed stuff? Can I talk M&A here?
Yes, I want to.
You guys have been so acquisive.
Yeah,
I mean, there's been a lot of M&A in your space. You've been much more aggressive than others in your peer group. Why now in terms of the aggressive posture?
Well, I wouldn't characterize our posture as aggressive. It's really, for us,
expansive. That's for sure.
Well, certainly it's expansive. It's been a dynamic year for us, but primarily from an organic growth perspective. Huntington has been growing way faster than almost any other bank in the industry at this point from an organic perspective. And so when we think about these partnerships that we've announced, we have the pleasure to announce 2 partnerships this year. It's really all in service of sustainable long-term organic growth. We want to.
You call them partnerships, not acquisitions.
We really do, and that's intentional.
Yeah.
the partnerships we've created with Veritex Bank and then Cadence Bank really are, in fact, bringing these organizations together, making 1 + 1 = 3. And for us, we'll be a powerhouse in Texas. We'll be present in a lot of terrific markets across the South, and really together we're going to be a much stronger organization. So they really are partnerships, and ultimately all in service of long-term sustainable organic growth.
So, I've got family in South Carolina. They've noticed some economic softness, and certainly the Veritex deal was about North Carolina and South Carolina. They've seen softness in real estate, which had been on fire. I'm just curious, your expansion plans there, your organic growth that you want to do there, I think you guys were looking to open more than 50 branches in those states. So is that impacting any of the growth, or you're on target for that?
We're on target for that. In fact, next year we expect to open 1 branch every 2 weeks in the Carolinas. So we've got some products for your family, and we'd love to take you on as a customer. But we're really excited about that. And in fact, the market reception we've had so far has been tremendous. We've opened several new branch locations just in the last few months, and each of them have beat their full year, first year deposit plan before they've even opened, to give you a sense, because the market reception has been so strong.
So look, I know, I can ask the question, but in terms of what you have planned, any more acquisitions?
Look,
how are you thinking about it?
The way we're thinking about it is if something comes up that's
KeyBank
opportunistic.
CEO said they expect more. They expect more acquisitions to happen. Do you?
I think the industry has been consolidating for 20 years. It will continue to consolidate. For us, if something comes up that's accretive to organic growth, that's a great fit for us, we'll consider it. But otherwise, it's all about organic growth for us.
Geographically, what's an area of the country that's of interest to you where you don't have a presence?
We love the markets that we're in right now.
Yeah.
Our markets, we're going to be in 21 states, covering more than 50% of the population of the country, and in markets collectively that are growing 30% faster.
But that means a lot
average.
of states you're not in.
True. I think our view is we're not trying to be a national bank. We're trying to be deep.
You are not trying to be a national state.
No, explicitly.
Okay.
We want to be deeply present in the states that we're in.
So would that mean that if there were more expansion, it would be within the states that you're already in, so you can become bigger in those places rather than expanding the geographic footprint of places you're not already?
If something fit, I think that's the right characterization.
Okay.
Yes. But I think, again, that's not our objective is not M&A per se. Our objective is organic growth.
The Goldman Financials Conference, and I think that's part of also why the KBW Bank Index really rallied in a big way. Outperformance about 2.5% higher. Many said, and you guys presented there too, that they're seeing a stable consumer despite worries of an economic slowdown. What are you guys seeing?
We're seeing the same. I think we just we're up on stage this morning ourselves at the conference. Stable consumer. Pipelines continue to be strong from a lending perspective on both consumer and commercial. Profitability is very strong. Credit is very stable. It really looks like a solid economy from our perspective. If all you did was read our internal reports, it would belie what you're hearing in terms of the headlines, which is very encouraging as we go into the end of this year and into next year.
Why do you think you're seeing that distinction? Like, you're seeing something, the anecdotes and indeed some data are showing softness in places. Why are you seeing strength?
Well,
in
look,
your
I think
consumer?
in total, you're seeing consumer spending continues to grow. Corporations, I think, are more confident today than they would have been at the middle of this year when there was more uncertainties in the environment. We've had a tax bill pass. We've had more tariffs certainty come into the environment. The government is now functioning again. I think as companies are looking forward into 26, they're seeing this is another year of growth. The Fed just came out today saying that the outlook for economic growth next year was more than 2% GDP. And so that looks like an environment where we should continue to be investing, continue to be expanding, and from a commercial and consumer perspective. There is, of course, a bit of a so-called K-shaped economy happening. And I think certain segments of the consumer environment have faced pressures, particularly from inflation and higher interest rates. Our bank does not have much exposure to that. And I think in many cases, the net of growth has continued to be positive.
Who is your typical consumer?
From us, we're focused on the mass affluent consumer base. And
so
then
that's
from a commercial,
you specifically target?
We do.
Okay, sorry, forgive me. Go ahead.
We target the mass affluent, and we've got a very strong base of consumers that are in that segment. And then, of course, we also have one of the largest small business banks and commercial banks in the country as well.
What does mass affluent mean in your markets?
Typically we're looking at customers who have a net worth of or income of more than $100,000, net worths that are high. Of course, we bank everyone, and our tagline is "Welcome to all," and we mean that. But for the most part, our business is concentrated in that mass affluent segment.
So, loan origination activity. Tell us about what you're kind of seeing since you last reported.
Yeah, in fact, we just this morning showed quarter-to-date loan growth of $2.8 billion sequentially from last quarter.
Yeah,
we're growing at about 8 to 9% year on year right now. And actually exceeding our own forecast that we set just a month ago.
In the Fed press conference today, I found what Jay Powell said about AI really fascinating, this idea of productivity.
Yeah.
And it's going to get me to ask every single person I talk to about how, not just how they're using AI, but like productivity increases at your bank. Like, what are you seeing? How are they using it?
We're doing a lot in AI, actually.
And it's increasing productivity?
It sure is. I mean, to give you a sense, last year in the fourth quarter, we had 2 Gen AI projects going through our risk evaluation and implementation. Today, we have 30. Wow. And there's about a dozen per month that are coming into the pipeline. Software engineering is being made much more productive. We're seeing all manner of internal process improvement, and now customer-facing applications as well, things that make the loan approval process seamless and more effective, more personalized service.
So is that going to increase earnings for you?
Look, I think it will certainly create capacity for us to then invest more. Our modus operandi is to harvest and try to drive efficiencies in the baseline costs so that we could deploy those expenses into investments.
A few years ago, I used to actually drive up to make a deposit. I used to talk to a teller. I mean, I was a kid at the time, and had my little book. But having said that, I don't talk to a teller for the most part anymore. So will AI, in your estimation, we are talking to CEOs, our tech team just did a big AI report, and they're talking to executives across industries. Everybody seems to be in on AI. But in terms of Fed Chair Jay Powell saying AI hasn't really impacted the labor market yet. Will it? Does it? It has to, right?
Look, I think in the end, AI will touch almost every element of human life and commercial activity, and ultimately will supplant many of the more rote processes that we use people to do, but it'll mean people could do other things. This will be a change in the labor force in terms of what people are doing. And there's things that people can uniquely do. Make judgments, be creative, interact with other people, lead organizations. I think, what's incumbent upon all employees, and I think about this myself, is, where can I shift my activities to where I uniquely add value?
People matter. You matter. You matter.
Oh, thank you.
I'm just saying.
You matter.
Zach Wasserman, thank you so much.
Pleasure to be with you.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.